Good afternoon, everybody. It's a pleasure to be here. Big thanks to Christian for inviting me to speak. My name is Pavel, and I'm based in Toronto, Canada, and I run 3G Capital Management LLC. Today, I'd like to tell you about one of our favorite investment ideas, but before I do so, some brief information on 3G Capital, the firm that I run. So 3G Capital is a private investment partnership that looks to invest in undervalued businesses around the world. Our investment universe includes frontier, emerging, and developed markets. We seek to invest at single-digit multiples in a small collection of industry-leading businesses. To be more specific, we'll look for companies which occupy number 1 and number 2 positions in their respective business segments. And we tend to stick with industries where the number 1s and number 2s tend to stay in the lead for many decades. We'll look to invest in businesses that generate returns on capital of at least 20% and have a debt payback period, which we define as debt divided by free cash flow, of less than 3 years. Finally, when it comes to valuation, we're extremely disciplined and we'll look to pay no more than 4 to 10 times normalized sustainable earnings for the businesses that we buy. We've been in business for over 19 years, and in the course of our existence, we produce a track record of significant outperformance versus our benchmark. With this out of the way, and before we talk about our favorite investment idea, I'd like to talk to you about the idea that I presented here previously, which is a company called Kaspi, which I presented at Valuespain back in 2022. I think the review of this idea should give you a pretty decent idea as to whether you should even be sticking around for the rest of my presentation. So Kaspi, by way of background, is the largest digital marketplace, payments, and fintech ecosystem in the country of Kazakhstan. The Kaspi Super App is deeply ingrained in the lives of Kazakhstani consumers. It is so deeply ingrained that it actually has engagement ratios that are far in excess of those for the most prominent global platforms, such as, for example, WhatsApp. The company is run by a brilliant management team that took the business from zero in profits to over $1 billion in profits in less than 12 years. And in the course of doing so, they tackled extremely complex challenges, and they succeeded every single time. When we presented the company, it was selling for a mid-single digit multiple of earnings and a double-digit dividend yield. And as you can see from the time of the presentation, the total return for the business was 150%, or just slightly over 150%, versus 5% return for the benchmark. So now let's talk about our favorite investment idea. The idea I'd like to talk to you about today is a company called Genomma Lab International. This is a company that's based in Mexico City, Mexico, and it's one of the largest providers of OTC pharmaceutical and personal care products in Latin America. The company's brands occupy number 1, number 2, or number 3 positions across their respective market segments. The company's geographic presence spans 18 countries, primarily in Latin America. In terms of product split, the company is 50-50 between personal care and OTC pharmaceutical products. And in terms of geographic split, 40% of revenues are derived from Mexico, 40% from Mexico, 50% from the rest of Latin America, and 10% of sales are derived from the US. The company is currently selling for about 5.5 times earnings and has a dividend yield of about 6.5%. I know normally when it comes to investing, people always struggle to see if they should be buying a good business at a fair price or a fair business at a good price. Fortunately, if you look in a Genomma Lab, you don't really need to compromise on either business quality or price, because essentially the price is a good one and the business is a very good one as well. So more detail on the business in the following slides. So what I'd like to tell you before we get into the business discussion is here's some information on the company's products. So basically, this is the personal care product lineup for Genomma Lab. They provide things such as skincare products, beauty care products, hair care products. With respect to the OTC pharmaceutical product lineup, they produce things such as pain relief, anti-cough, anti-flu, etc. In terms of selling, they sell through supermarkets, mom and pop stores, pharmacies, and basically, you know, if you go to a pharmacy anywhere in Latin America, you're going to find the company's products occupying prime shelf space. So here's an example of some of the company's products on the shelves. So here, some pictures of the company's production facilities, which is where they make the products that I just discussed. So there's a production facility right here. So you can see the production equipment. The facility is state-of-the-art. They have the best equipment in the market, actually the equivalent of buying a Bentley, and highly automated. I think at any given time you're going to have no more than 15 people at the production facility. And on the upper right is actually myself. They make you wear a hazmat suit because they make sure that they keep the plant very, very clean. So now let's explore the 3 dimensions of the Genomma Lab investment case. And the 3 dimensions are business, management, and price. So let's start with the discussion of the company's management. Let's see if the management of Genomma Lab is of good quality. So anytime we talk about good business, for us it always necessarily starts with having a strong competitive advantage and a sustainability of that competitive advantage. And Genomma Lab's competitive advantage is built upon the company's market leadership. If you look at the company's brands, they occupy number 1, number 2, or number 3 positions across the respective markets. The company's leadership position is sustained by the 2 main pillars, which are brand power and distribution reach. With respect to brand power, the company's brand power is consistently reinforced across both traditional and digital media. So if you look at the specific metrics, you're going to see that Genomma Lab is the number 1 TV advertiser in Latin America, the number 1 content producer, multimedia content producer in Latin America, and they have number 1 digital brand awareness in Latin America. And even beyond that, just anecdotally, they have the best speed to market when it comes to advertising in Latin America. I can share with you the following information. For example, if you talk to people at Procter or you talk to people at Pfizer in Mexico, they're going to tell you that the most hated competitor of theirs is Genomma Lab. And the reason that they say it is because Genomma Lab is so much quicker to market than Procter or Pfizer can ever be. For Procter or Pfizer, it normally takes about 6 to 9 months to produce an advertising spot. And for Genomma Lab, it's about 2 weeks. So Genomma Lab can quickly adjust its marketing campaigns if it's not working, and Procter & Gamble just cannot keep up. So the second pillar of the company's leadership position is the distribution network. The company has a vast distribution network across Latin America. They sell their wares across over 500,000 points of sale, and over 80% of those points of sales are served on a direct basis. If one were to try to replicate the brand power and the distribution reach for Genomma Lab, that would easily cost north of 50 billion pesos. And you'd never do it given the fact that Genomma Lab market cap is about 13 billion. I think you would just make an offer for the company at a premium and just do it that way. I think there's a high likelihood that the company's leadership position is here to stay. The reason that I say it is because if you study the history of fast-moving consumer goods companies around the world, what you're going to discover that the industry leaders such as Procter, Colgate, J&J, they tend to stay in the lead for many, many decades. Now let's review the economics of the business. As one would expect with a company with a strong competitive advantage, the economics of the business are truly impressive. The company earns approximately 30% on tangible book. They produce 20% operating margin with minimal capex. The go-forward margins are likely to expand substantially as the company's new manufacturing facilities come on stream. And lastly, the company has a very solid financial position. They have debt payback period, which is debt to free cash flow less than 2 years, and they have AA+ rating from Fitch. As I said before, it is likely that those impressive economics will continue over the long term in the future. And the reason that I say it is because, again, if you study the history of the fast-moving consumer goods industry over time, what you see is that market leaders tend to stay in the lead for many decades. In addition to having sustainable competitive advantages and great economics, the company also has pretty decent growth potential. The company operates in very large and growing markets. By way of comparison, the company's end markets in Latin America, they include about 650 million people, compared, for example, to the US, which they have twice the number of people. The population in those countries also grows 10 times faster than the population of the US, providing further growth potential. And lastly, the GDP per capita in those countries is very small compared to the US. It's probably 20% of that of the US, and yet it's catching up fast. So the company has a good tailwind from just the underlying market growth, and they can augment that growth by taking more market share within those growing markets by introducing additional products, which is what they've done over the course of their existence. Now that we established that Genomma Lab is a good business, let's talk about the company's management. Anytime we look at management, there are three things that we evaluate, the three critical elements, which are the operating skill of the management team, their capital allocation ability, and shareholder alignment. So let's look at each one. So in terms of just brief background on the management team, they came over to Genomma back in 2014, which is when the business fell in hard times because they lacked industry-specific expertise and they had lack of institutional infrastructure. The new team had decades of experience accumulated across the best-in-class, fast-moving consumer goods companies, such as Procter, L'Oreal, PepsiCo. When current management team came on board in 2015, the company generated sales of about 11 billion pesos, and they were losing about 70 million a year. So last year, the company generated $17 billion in sales and about $3.5 billion in EBIT. Clearly, a great track record when it comes to operating the business. How did they do it? They did a few things. Number one, they refocused business on the best and the most profitable brands. So they really cut back on the number of brands. They cut them in from about 60 to about 20. They dramatically cut back on the number of SKUs. They also reduced their costs substantially by optimizing their infrastructure. They reduced their warehouse space by about 70%. They cut their office space in half. From a financial standpoint, they got their working capital management in order as well. They used to have a cash conversion cycle before the new management team came aboard of probably 180 days. And I think as of the most recent quarter, that number stands at 83. Of course, being good operators is not enough to say that a management team is a good one unless you consider the capital allocation angle. And the management has done a good job on that front as well. If you look at what they do with the cash, the first order of business for them is putting the cash back into the business to the extent that they can augment the company's competitive advantage and improve profitability. One recent example is the company's investment in new manufacturing facilities to improve their supply chain. And as a result of that investment, what's going to happen is that you're going to have higher profitability because your margins are going to grow due to insourcing. You're going to have more of a cash flow because you're going to reduce inventory substantially. And lastly, you're going to improve customer service quite a bit because you're going to have so much better visibility into your supply chain. Of course, it's a capital light business, so there's plenty of cash left over after you reinvested whatever you need to reinvest in the core business. And unlike many companies in the space, Genomma Lab and its management are very cognizant of returns on capital when it comes to allocating capital to external growth opportunities. In the recent years, they actually prefer to return virtually all the capital that the business generates back to the shareholders via dividends and share buybacks. And the reason that they do it is simple. They look at the stock price and they say, you know, our business is selling for less than 1 times EV to sales. And if we were to acquire a business right now, we'd probably have to pay 3 to 4 times EV to sale. So why would we ever acquire a business at that price whereby we can just, you know, acquire our own stock at probably, you know, a quarter of the going multiple in the marketplace? So they've been very skeptical about making acquisitions at those high multiples, and their preferred way to expand is by basically just doing partnerships with companies outside of Latin America that have product and manufacturing expertise in certain segments. So they take those products and they use their marketing and distribution network to introduce those products into the Latin American markets. And finally, in terms of shareholder alignment, the company's chairman and also founder, Rodrigo Herrera, he owns about 30% of the business, making sure that his interests are tightly aligned with those of minority shareholders. And finally, the easiest part is pricing. If you look at the company's valuation, I think it's obvious it's significantly undervalued. A couple of ways to look at it. You can look at the price-earnings ratio. It's about 5.5 times with a 6.5% forward dividend yield. And EV to sales for Genomma are less than 1 times. Now you can look at the company's own historical PEs, and historically the company traded at about 15 times on average. You can look at the global fast-moving consumer goods companies, and they're selling at about 16 to 22 times earnings. You can look at the MSCI World Index, selling for about 18 times. And another way to look at it, you can just look at private market buyout multiples. I think in the past 10 years, they ranged about 2.5 to 6.5 times compared to the company's EV to sales ratio of 1. So I think however you slice it, the company is substantially undervalued. Of course, no discussion of a business case is ever complete without discussing the potential risks. So here are some of the risks that are worth considering. The first one is the risk of an economic slowdown. I think the company is fortunate in a way that its products enjoy low price elasticity. And so what happens is even if there is an economic weakness, that low price elasticity provides for a fairly stable revenue situation. You also face currency risk. And again here, due to the fact that the company's products are low ticket items and they're essential items, what Genomma has been able to do historically, they've been able to raise prices consistent with any FX depreciation, thereby maintaining the prices in stable currency at the same level. In terms of corporate governance, a couple of angles worth considering as well. We normally look at the operating situation at the company, and we want to be sure that in terms of the profitability, the company's profitability has to be somewhat consistent with the underlying competitive advantage and the company's market position, because you want to be sure that they're not under-earning so that there's some transfer of value away from the shareholders. And if you look at Genomma Lab, what you're going to see is that their profitability is actually consistent with that of their peers and consistent with that of their underlying market position. So we conclude that there is no value leak on the operating side. We also look at value leaks on the capital allocation side. Again, you don't want those companies to be allocating value away from the minority shareholders by doing deals that favor third parties. Does not appear to be the case with Genomma because, as I said before, They spend virtually all their free cash flow on share buybacks and dividends, so all the cash flow goes right back to the shareholders. And finally, you have to consider the fact that the company's chairman founder, he was actually the person who created a lot of shareholder value. He was responsible for that major strategic value creating pivot back in 2014 when he decided to restructure the business and bring the entire new management team on board. And after that, the company just scored touchdown after touchdown. Finally, we have to consider the geopolitical angle. How likely is that there's going to be a major geopolitical conflict to such an extent that it will impact the interest of shareholders, of, let's say, American shareholders in the Mexican business? I don't think that's likely because Mexico is firmly in the U.S. geopolitical orbit. So I don't think there's going to be such a big crisis at some point that Americans or Western investors are going to be banned from owning Mexican stocks. So just to summarize, Genomma is a company that operates across a collection of large and growing markets. They enjoy a strong competitive position across those markets, which should enable them to grow within those markets as they consolidate their positions against weaker competitors. It's a stable and cash-generative business that requires minimal capex. They carry a modest amount of debt, return most of the cash flow back to the shareholders via dividends and buybacks. The chairman founder owns substantial equity in the business, thereby aligning his interests with those of the minority shareholders. The company is available at a highly discounted price, and while some risks do exist, they're more than absorbed by a substantial margin of safety. So with that, I'd like to open it to questions.
Hi, thank you for your presentation. So I had a question on the founder, Rodrigo Herrera. Seems to me that he was involved in some sort of cloudy events, a few years back, and to the point that the board sort of ring-fenced him so that his legal issues didn't permeate the company. So my question is, why is that not a problem? And do you think the multiple should have some sort of corporate governance discount as a result of that?
Well, as I just explained, the way to evaluate the risk from the corporate governance side is look at the track records. And if you look at the track record for the business, both with respect to their operations, capital allocation, and alignment, I have not seen an issue. Like I said, where I would get concerned is that you have a company like Genomma with a great competitive position and perhaps earning 10% margins or 5% margins. I'd say, you know what? That's suspicious, probably because maybe they're buying something from a third-party inflated prices because they're just transferring the value away to a third party. But I haven't seen evidence of that. They're performing at the max when it comes to monetizing the economics of the business. With respect to capital allocation, they send every single peso back to the shareholders in the form of dividends or buybacks. They're not making any acquisitions that transfer the value away from the shareholders into a third party. And also, if you look at what happened back in 2014, so up to that time in 2014, that business was not run properly. It was not run in an institutional manner. And Rodrigo Herrera was the person who said, you know what, we can't really do it. He fired all the relatives that he had at the company. He said, look, we're not going to run it as my personal fiefdom, but we're going to run it as a proper business. And he was the guy who brought on all those people from PepsiCo, Procter, L'Oreal. And as a result of that, there was major shareholder value created because the profits went from a loss of 70 million in 2014, and they're 3.5 billion now. So again, are his personal problems going to leak into the business? Who knows? But I know he treated the shareholders of Genomma really well. Of course, you never know if that's going to change. But so far, I haven't seen anything that would make me think that there's going to be an issue with corporate governance.
Thank you very much for introducing this company to us. If I understood correctly, current valuation, current multiple is very low according to his historical multiple.
Right.
Why is that?
Well, and just to give you an idea, if you compare today's multiple to a multiple from 5 years ago, that's not really apples to apples, because 5 years ago the company had a lot more debt. The debt payback period was like probably 7 years, so a little too high for my taste. The company did not own their production chain, so again they were dependent on third parties to manufacture their products, and so not apples to apples. And the reason that it's cheap today, I think one of the biggest reasons that I've seen is because 10% of their business is actually derived from Argentina, and I think Argentina had their share of economic issues, and I think there is a concern from investors that the business in Argentina for Genomma Lab is going to create an issue for, I guess, for the company, for the whole company, which, to an extent, it might be true, but again, it's only 10%. That's number one. Number two, they've been managed to navigate it quite well. I think I discussed the FX risks for the business, and just to get more specific here, so in Argentina, so the company is able to raise prices in line with currency depreciation. So to the extent that Argentine currency, let's say, gets cut in half, the company is able to raise prices, by the factor of 2. Thereby, the price in Mexican pesos is pretty stable. So, of course, there is an issue of them not being able to take profits out at the moment. So what they're doing now with the cash in Argentina, they're basically just buying up inventories and investing in new products. But, at some point, they're going to be able to do it, and they'll get that cash back.
Just to follow up on that question of why is it so cheap? Because the fast-moving consumer goods in India, for example, trade at P's of 60. So why in one market are people willing to pay a very high valuation for the potential growth in consumer goods and not in Mexico? Maybe it's something to do with the in India it's the international brands sold in India, so maybe that might explain that you pay more for that brand. But it seems to be a massive valuation discount. So could it be the investment universe, that people just not wanting to buy Mexico, or what's the explanation for that difference?
That could be part of it. The only thing I could find was the fact that perhaps it's Mexico, but then again there are tons of other companies in Mexico in the fast-moving consumer goods space, and they're selling for much higher multiples. Like you can look at the buyout multiples across Latin America. And the buyouts took place at whatever, 2.5 to 6.5 EV to sales. And Genomma Lab is 1.5 or 1 times EV to sales. So the only thing I can think about is the exposure to Argentina. I think that just creates a bit of a headline exposure. But again, that's more of a headline exposure rather than sort of like real economic exposure. And, one way to deal with it, you can say, listen, okay, let's assume that Argentine business is worth 0, which it's not, but, for the sake of the argument. So that's 10% of your business. Okay, so it's not, 6.5 times or 5.5 times, so it's whatever, 10% more. So it's, 6 times or 6.5 times. Like, that's still very cheap.
Pavel, hi, thank you for the presentation. I was just wondering if you had done any work in terms of portfolio concentration. So some of these companies, they tend to have like a few blockbuster kind of successful products that they generate most of the revenues around. So that was one. And then if any of those were related to, so I understand there's some pharma exposure within the product suite. So perhaps some thoughts about generics risk, which I know that the market is usually very iffy about, and it might be a reason for cheapness as well in terms of any patent cliffs or any of that work that you might have done.
So I think when it comes to pharma, it's important to understand that they deal with OTC pharma rather than prescription pharma. So whatever they do, there is no patent to it. So of course there is always risk with respect to generics, but again, if you study the history of OTC pharma, the generics risk was present for as long as OTC pharma has been around, and they haven't derailed the investment case for any OTC pharma producers. And I think there is a reason for it, because what you sell in trust, right? So if you think about it, all of those people who make OTC pharma, they buy the powder to make the pills from 3 producers. So they buy the powder from the same source. So technically, whatever you buy from Genomma Lab, or I don't know, you buy it from, you buy Advil in the US or Tylenol or whatever, like it should be the same, right? It's the same powder. But I think where the difference is, as a consumer, you don't know if it's the same. You don't know if they're gonna be mixing something in, like how pure are gonna be those people who put those things together. So you sell in trust. And it's not very expensive to buy the pill, but I think the impact on your health can be dramatic. So I think what most people say, they say, you know what, I'd rather just pay up a little bit more for the fact that if I buy, let's say, Tafirol in Argentina, I know I'm not gonna have a health issue. But if you buy something generic, who knows what kind of powder they put into the pill. So I think that's why I think as the number 1 player in that segment, you have a very solid competitive position. Because again, like if it's me in the US, I see Advil, I don't really care about the price. I'm gonna buy Advil, I'm just not gonna buy anything else. Because like you see all those cases where people are saying, I'm gonna take the lowest bid. And like recently in the US, there was a big case with people going blind from eye drops. So what happened is they go to the store, as opposed to buying Blink, which is like the number 1 eye drop made by S.C. Johnson. They say, you know what, we'll just buy the cheapest one, and who knows like where it's made, just some generic. And they put in the eye, and they get a bad infection, and it's antibiotic resistant. And they ended up losing their eyesight. Their eyes had to be taken out. So I think if it's me, I'm like, you know what, I'm probably gonna stick with the product that's just the number 1 product.
And just on portfolio concentration on the whole, any, just in terms of the products that are making up the revenue base?
Portfolio concentration for Genomma Lab?
Yes.
Yeah, like it's, it is fairly concentrated. I think in terms of SKUs, I think, there are like 18 brands. I think, I want to say it's like 200 SKUs. So I guess there's not a ton of concentration. I'd say with 200 SKUs, it's still fairly diversified. But I think what they discovered and what I've seen similar experiences for like Procter back in the day and Colgate is that if you're just way too diversified, you spread yourself too thin and you end up just not having good profitability. Like your best bet is focusing on the biggest and the most profitable brands and putting your resources behind them. Like that works way better than having 1,000 brands and then putting a little bit of resources behind each.
Okay, thank you very much.